Welcome back to GavTax, where we help real estate investors grow smarter and keep more of what they earn. In this video, we are breaking down the most important accounting practices every real estate investor needs to follow, whether you are actively managing properties or investing passively through partnerships and syndications. Because here is the truth. Bad accounting doesn't just lead to sloppy records. It leads to missed deductions, audit risks, and higher tax bills. But when you get this right, you unlock more cash flow, more control, and more long-term profits. Let's begin by understanding why accounting matters so much in real estate. Many investors think real estate is simple: collect rent, pay expenses, pocket the difference. But the reality is, real estate has layered tax rules, non-cash deductions like depreciation, and critical timing considerations that can either save or cost you thousands. Good accounting helps you track real ROI, accurately deduct expenses, stay compliant with IRS rules, plan for major tax events like sales or refinances. And without it, you're flying blind. Moving on, let's talk about accounting methods. Most real estate investors use the cash basis of accounting. That means you record income when you receive it and expenses when you pay them. It's simple and works well for most small to mid-sized portfolios. On the other hand, accrual accounting, where you track income when earned and expenses when incurred, might be used for larger operations or for reporting consistency across entities. Whichever you choose, just remember to be consistent, apply it across all properties, and report using the same method to the IRS. Let's now shift to a foundational rule. Keep your personal and real estate finances completely separate. If you are still running property income and expenses through your personal bank account, it's time to fix that immediately. Set up a dedicated business bank account for each entity or property. Use it for all transactions, rent deposits, contractor payments, mortgage interest, insurance, and repairs. Why does this matter? Mixing personal and property funds increases your audit risk, muddles your records, and can even undermine your liability protection if you're operating through an LLC. Next, let's talk about a powerful tool that keeps your accounting clean: the chart of accounts. This is simply a list of categories used to organize your transactions, and it's the backbone of any good bookkeeping system. For real estate, your chart of accounts should include categories like rental income, property taxes, repairs and maintenance, legal and professional fees, mortgage interest, capital improvements, depreciation, utilities, property management fees. With a clean chart of accounts, your financial reports become clear, audit-ready, and incredibly useful for tax planning. Now, speaking of depreciation, let's dive deeper into that, because it's one of real estate's most valuable tax tools. When you buy a property, you don't get to deduct the full purchase price up front. Instead, the building's value depreciates over time. 27.5 years for residential, 39 years for commercial. That means each year, you deduct a portion of the property's cost, without spending a single dollar. Now, let's clear up a big misconception. Repairs and capital improvements are not the same thing, and misclassifying them can create real tax problems. Here is the difference. Repairs, like patching a roof, fixing plumbing, or repainting, are deductible in the year paid. Improvements, like replacing the entire HVAC system or remodeling a kitchen, must be capitalized and depreciated over many years. If you deduct an improvement as a repair and get audited, the IRS could disallow the expense and charge penalties. Next up, let's cover a term that comes up a lot: basis. Your tax basis in a property is basically what you have invested in it for tax purposes. It includes the purchase price, closing costs, capital improvements, minus depreciation taken. This number matters because it determines how much gain do you report when you sell, whether you can deduct passive losses. What happens when you refinance? If you don't track your basis, you are left guessing at the most important moments in your investment life cycle. Keep this updated, especially if you are investing through partnerships or syndications. Now, let's touch on something that gets investors in trouble far too often: Form 1099 compliance. If you paid any independent contractor more than $600 this year, you likely need to file a 1099 NEC. That includes plumbers, handymen, property managers, landscapers. Failing to file can result in fines up to $290 per form. But even worse, if audited, the IRS could disallow those expenses entirely. To avoid the drama, do the following. Collect W-9s from vendors, track payments, submit 1099s by January 31st each year. Let's now talk about something that confuses a lot of high-income earners: passive activity loss limitations. Real estate losses, like those created by depreciation, can usually only be used to offset passive income. That means if you have a W-2 job and only one rental property, you may not be able to use those losses today. But those losses aren't gone. They are suspended and carried forward until you generate passive income or sell the property, and if you qualify as a real estate professional, you might be able to use those losses against active income like wages or business profits. But you must meet strict criteria. Before we wrap up, let's talk about exit planning, because selling a property can trigger the largest tax event in your investment journey. You will owe tax on capital gains, depreciation recapture, possibly state taxes or net investment income tax, but good accounting gives you options, like 1031 exchanges to defer gains, installment sales to spread income, opportunity zones to reduce or eliminate tax, or using prior passive losses to offset gains. Don't wait until after closing. Tax planning should begin before the property hits the market. All right, let's bring it all together. Good accounting isn't just about record keeping. It is a wealth building strategy. Here is a quick recap. Separate your finances. Use a real estate specific chart of accounts. Track depreciation and basis. Know the difference between repairs and improvements. Stay compliant with vendor payments. And always plan for taxes, especially when you sell. Need help reviewing your books or structuring your next deal? Book a one-on-one strategy call with us today at gavtax.com. We will help you save time, money, and stress. Thanks for watching. Be sure to like, subscribe, and turn on notifications so you never miss a tax-saving opportunity.